Thanks for joining David, Kevin, and myself for the market update for the month of October. We hope you guys had an absolutely fantastic Halloween. I know I sure did. David and Kevin are going to talk about what's happened in the economies both in the US and in Canada. But a quick recap is both the Canadian and the US markets were slightly off. What was more important in my mind was both the Bank of Canada and the Feds held their interest rate steady for the second consecutive time. So again, I'm going to pass you on to the guys. Take care. If you need anything, don't hesitate to call. Bye.
So Kevin, what was going on with the economy in Canada in October?
Preliminary data from StatsCan suggests that the Canadian economy may have entered a technical recession as interest rates continue to weigh on consumer spending. Now, a technical recession is defined as 2 consecutive quarters of negative growth. Third quarter preliminary estimates suggest that the Canadian economy shrank at an annualized rate of 0.1%, so hardly negative at all. But if the fourth quarter comes in negative as well, we will meet the definition of a technical recession. Now really this isn't all that surprising when you consider many Canadians have variable rate mortgages and are feeling the pinch of the higher interest rates we have today. On top of that, we did see unemployment in Canada rise slightly to 5.7% in October. Now this weaker than expected data reinforces forecasters' expectations that the Bank of Canada is probably done raising interest rates. However, it will take continued weakening of economic data and probably inflation below 3% before we see the Bank of Canada begin to consider rate cuts. Currently, inflation sits at about 3.8% in Canada as of September. David, tell us what was going on in the US economy.
Despite a laundry list of headwinds, the US economy remains quite resilient. In fact, Q3 economic growth in the United States came in at a blistering 4.9%. This is the fastest rate of expansion since Q4 2021 when we had the COVID vaccine first released to the public. The main reason that we think that economic growth in the United States may remain fairly resilient is number one, the US consumer is still in pretty good shape. In the US, consumers are a lot less interest rate sensitive in our view compared to Canadian counterparts. In Canada, as we know, many Canadians are feeling the pinch of variable rate mortgages, as well as the fact that a lot of people's mortgages do come up for maturity quite frequently and they're being forced to renew at these current higher rates that we see. Conversely, in the United States, a lot of borrowers have longer terms to maturity and much lower fixed rate payments currently. And so we think this should be a tailwind for the US economy for a little while yet. As well, despite some softening in the US real estate, prices have come down amid these higher interest rates, no different than here in Canada. People's net worths in the United States still remain at near all-time highs. And so when this is the case, the consumer still feels pretty confident. Although we're still likely to see market volatility like we've seen in the last 2 years, over the next little while, we do think there's still quite a few reasons to remain optimistic about the US economy. Again, number one is the consumer is still quite strong. Number two, inflation is cooling, much like we're seeing here in Canada. It's certainly not back at the 2% target that the central banks want it to get to, but it is continuing to trend in the correct direction. We've got positive economic growth in the US, so we certainly don't expect the economy down there to continue to expand at 4.9% per quarter. There certainly will be softening in the next little while. We just don't think that it's going to soften as much as we may see in the Canadian economy over the next 12 months. And again, US unemployment numbers are lower than here in Canada as well, so the job market continues to be a little bit stronger in the US as well.
Thanks, David. Even though volatility may make some investors want to take a step back and sit on the sidelines, knowing when to jump out and jump back in remains an almost impossible question. As you can see on the chart on your screen, which shows the growth of a $10,000 investment in the S&P 500 over a 35-year period, 1985 to 2020, during that amount of time, if investors missed only the 5 best days in the market, that's 5 days out of 35 years, they gave up 50% of the returns received by investors who held strong and remained invested throughout volatile market conditions. While remaining invested may feel like doing nothing, History shows that remaining calm and avoiding knee-jerk reactions garners the best chance at long-term success.
As always, should you have any questions about your portfolio or the markets in general, we'd be happy to hear from you.
Take care.